Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Kris Benson. Thanks for being on the show, Kris.
Thanks for having me, Whitney. Pleasure's mine.
We're honored to have you on the show, Kris. I've seen you doing lots of big things, and we talked over a year ago, and I knew you'd be a great guest for the show. But a little about Kris. He's the Chief Investment Officer for Reliant Investments, a subsidiary of Reliant Real Estate Management, and one of the top 30 commercial self-storage operators in the U.S. in 2018. He is part of the investment committee and develops institutional quality self-storage investment opportunities for accredited investors. His investing goals have always been about changing the paradigm of trading time for money in order to have time for more of the things we love to do. Likewise, investing in real estate has been Kris's steadfast path to passive income, and he is passionate about inspiring others to change their mindset around investing for their future. So, Kris, again, thank you for your time today and being on the show. Look forward to our conversation, but tell the listeners a little more about who you are and where you're located and your focus right now.
Yeah, for sure. Where I'm located is the easy part. We're in Roswell, Georgia. So our office is just outside of Atlanta, and that's where I'm talking to you from today. We're about 25 miles north of the airport. So just as far as who I am, so my background, Whitney, is really, I came from a sales background, first in business-to-business sales, and then got into medical device sales. And about 10 years ago or so, I distinctly remember waking up, Whitney, and saying, I don't think I can do this for another 20 years, or maybe 30. I was making great money, but lifestyle was rough. So that was sort of the beginning. Like many of your listeners, I'm sure, I read Rich Dad, Poor Dad and said, oh, passive income seems like an interesting way to make money. And so that was sort of the beginning of the journey for me. And we did some residential real estate starting, kind of followed the path that everybody does, realized very quickly that was miserable. I wanted nothing to do with that. And then we got into commercial multifamily in a number of different facets. About 3 years ago, we started investing in storage. Long story short, got to Reliant about 18 months ago. First, I was there as an investor. And then there was a partnership opportunity for us. And so I'm running the equity arm of the business at Reliant. So really, Whitney, managing investors and ensuring we have equity to close on our properties as we go out and expand our portfolio across the Southeast.
Nice. So you got into residential, so you had that day though I had that one of those same kind of days where it's like, okay, wait a minute, something has to change. I can't see doing this for 20 or 30 more years, and so that pushed me into another path, right? Like it did you. And so you started with residential. What was that? Single family, small multis? What were you doing at that time?
Yeah, small multis. We ended up with a portfolio of just about 20 units. I think 22 is what we ended up with. I still have one duplex left, but we mostly had duplexes in the county where I lived.
Nice. Okay. So then you got into commercial real estate, you started doing multifamily, then you've seen an opportunity to partner with Reliant. And I'd love to get into, what that means to run the equity arm and what that looks like. I mean, it's a big responsibility, right? I mean, for that group.
Yeah. So what happened, Whitney, for me organically is as I was, real estate was always a side hustle, and I still had a day job where I was surrounded by, essentially surgeons and hospital executives and other guys and gals like me who had a little bit of disposable income, and they knew what I was doing. And I was investing my own money at first. And kind of slowly but surely people started asking like, hey, next deal, I'd like to know about it. And so that group grew organically. And as it did, it gave me the opportunity to bring a little bit of leverage to negotiations where I could go to an operator either on the multifamily side or storage. And ultimately, that's what happened with both, and say, hey, I can bring a little bit of equity to the table. Can I have some back-end ownership if I do that? And so, I wanted my own money to be deployed. And then, people were trusting me with bringing them opportunities as well. So I got really good at underwriting and understanding, another operator's underwriting so that essentially I could make sure I was making a good decision for my own family and then, other people who were trusting me to do the same. So, on the self-storage side of things, it appeals to my skill set, right? So I'm a salesperson by heart. I just happen to understand real estate at this point. And so how I got connected with Reliant first was I wanted exposure to the asset class, to self-storage. And literally, Whitney, I just started calling the list of self-storage operators. There's a top 100 list that comes out every year. And I just started calling them until I found a few that would meet with me, basically saying, hey, I have some equity. I'd like to come meet you, see what your platform is. And, if I'm able to deploy some capital, can I earn some back-end ownership? And so that's what we did. And that worked out really well. I fell in love with Reliant and the guys who founded it. And Whitney, probably like many of your listeners, especially if you're looking at syndication, I'm a big believer that it's about the people, right? And you're investing in the platform, the real estate certainly, but for me, it's always guided me well to invest in the people first. And usually everything else takes care of itself. I think that's a good tip that everybody can take with them because, when things are going well, everybody's friends. It's when things hit the fan. And if you're in real estate long enough, it's an inevitability. That's when you find out who you've really partnered with.
Great advice. Great advice right there. No doubt about it. It's a relationship business. And when everything's good, it's easy for everybody to be friends, right?
That's for sure.
So, I'd like for you to back up though a little bit and that transition, before the transition actually, but you're meeting all these people and then they're coming and asking you questions, right? How did, I guess, elaborate on how they knew what you were up to, what you were doing?
Are you saying specifically from what I was investing in?
So just like, you were preparing, I know a lot of people that are listening are trying to raise capital and they're, they have an operator they're partnering with and, they're trying to get through that process that you did there, and finding that operator and raising this capital, meeting these high net worth individuals. And so just having those conversations, how did these individuals, before you really took that leap, to do this, how did they already know what you were doing and how did you, let people know?
I talked about it a lot. So, I think, Whitney, so two things is one, for the people who are trying to do that, I had a track record in that I had invested my own money. And I think that's a key thing, Whitney, right? Like syndication is now a very, very hot topic. Everybody wants to be a syndicator. And, there's a low barrier entry. It's not a bad thing to say, right? So essentially anybody can syndicate a deal. And the caution I would put out there is, understand what people are trusting you with. It's their time, right? They've earned this money to be able to invest with you because of the time that they spent to do it. And so I took that responsibility pretty seriously. And I would say that, the advice I could give is one, talk about it with everybody, what you're doing. And usually that will generate some organic conversations. Two, keep an email list, right? So when you ask that question or they say, hey, I'm interested, make sure you keep a list of who those people are so that you can bring an opportunity to them when you have it. The third thing, and this is what I would say, a lot of people ask like, hey, how do I get started? If it were me anyways, the first thing I would ask is, have you invested your own money? Have you done this before? And I think that's a critical component to this is, look, as syndicators, you have a great responsibility and, it's easy to make money in this space on a fee structure. But what you need to make sure of is you're being, a good steward of your investors' money. So, my thing was I felt comfortable talking to people about it because I had done it with my own money first and was still investing my own money in all the deals that I brought as a quote unquote syndicator. So, and that's still the case here at Reliant. So even though I'm an employee now, I'm investing my own money in all the deals because I feel just as good about the underwriting as I'm hoping that they will.
Nice. So I'd like to dig into just, what you do right now and for Reliant, because you're operating at a much higher level now. You've grown quickly and from those days of just talking to people, telling them what you're doing when you were a W-2 employee, to now doing this. I mean, this is your role every day. This is what you're working on. And so, can you give us, like a day, in the life of this, running this equity arm and maybe some things that are important to know in doing this well?
Yeah, I think for me, Whitney, as a salesperson, it's easy because the hard part's been done, right? I've partnered with a very successful operator who has a strong track record, right? So as a salesperson, it's pretty easy to sell things that, are basically sell themselves. I'm trying to find people who have a desire to diversify their asset class and what they're investing, into a non-correlated asset. And I think for me, the big shift has been for us, Whitney, is going from sort of that individual investor, individual high net worth accredited, to some of the larger family office institutional type money. We had an opportunity to meet with in a few of the university endowments. I'm going to throw a statistic out there for you, Whitney. Do you know how much money the top 20 university endowments in the United States manages? Just 20.
I don't.
$500 billion. So there's a quote that I love, and I've been on a bunch of podcasts and I've used it a bunch. I wish I could give credit to who said it, but I don't know. The answer and what it was is big deals and small deals are the same amount of work. You just make less money on small deals. And so the endowment thing has been a goal for us this year at Reliant to start to understand what they look for. We had the opportunity to meet with Harvard and Yale, who's number 1 and number 2 in the country. Harvard, just as an aside, manages $38 billion and Yale manages just under 30. So it's been really interesting to see how they look at investing. And what's interesting is the time frame. They look at it with a horizon of forever, because the institution of Yale, for example, will be there forever. And they believe so will the endowment, and the endowment has to exist forever. And so, it's a different opportunity than when you're talking to an investor who says, hey, I have this 3 to 5 year window. I want to see a turn on my money. When you're thinking 10 to 30 years, it opens up a whole different world of opportunities. So, we have a balance of individual investors. We have some syndicators who work with us as well. And then we have I would call this institutional bucket, where we have a number of family offices, and we're working on that university endowment to help us grow our portfolio. Because on our end, we have the ability to deploy equity. Last year, we just deployed just under 40 million in equity. This year, we're raising a $50 million fund. If we get that complete, we'll be close to 60 million in equity deployed this year. So, the opportunity still exists in self-storage to meet our underwriting standards. And so we're trying to take advantage of that by making sure that, we have the equity there when we need it.
Nice. So, can you go over some of the pros and cons of, the having the individual investors and now, moving to family offices, or the differences?
Well, I mean, the big one, not to make it too obvious, but the big one's just check size, right? And I say this to our investors all the time, in our fund right now, we have 3 shares in classes, right? And so our class C share is still a $50,000 minimum, which, most of our individual investors qualify for that class C share. And then we have a class B, which is $1 million, and then class A, which is $5 million. I mean, the big difference, Whitney, right, is just check size, right? So, most family offices, depending on how much money they have under management, if they're going to go through the underwriting process and the due diligence of you as an operator, they're going to usually deploy a bigger chunk of cash. Now, the size of that really depends on the size of the office, right? And how many assets they have under management. But, for us, the back office work is the same for a $50,000 investor as it is for a $5 million investor, right? Our administrative costs, exactly the same, right? The work that we're doing upfront, just about the same. But obviously the bang for the buck's a lot higher if you can get into the family office. Now, the other side of that, Whitney, right, is, their requirements are different, right? You can be an emerging manager, but typically they're looking for 2 to 3 years of track record. And on real estate, probably a little bit longer to see a full cycle or multiple full cycles you've been through. But it really depends on the office and what their particular mandates are.
So how do you go about getting connected with a family office? I know that's what a lot of listeners are thinking, well, but, that sounds really good just to get a $5 million check from one person, or they haven't thought about a family office before. Can you just tell us a little more about, how do you even begin that process?
Well, do you think it'd be helpful just to define a family office? Do most of
Yes,
your listeners
please.
know what it is?
Yeah, so, yeah, that's great. Let's back up. Please define
So,
a family.
yeah, I say it, and I apologize. I probably should have defined it up front. So,
I
family
should have
office.
asked.
Yeah, if we have a really wealthy family, so one of our partners is the Pagula family, and they made they're billionaires and made their money in natural gas, right? So they've created essentially a business to manage their affairs. Now, some family offices, that's just for the investing side. Some family offices, it's all over the board. Like literally, they'll manage your homeowner's insurance, health insurance, estate planning, essentially anything having to do with the family. Obviously, our focus is more on the investing side because that's where we have to offer. But those family offices can be for one guy. You can have Whitney. You could start your own family office, and then you have guys who have a few $1 billion in their family, and they're managing that wealth. And the number one goal, it seems, of every family office is preservation, right? It's like the Warren Buffett rule of investing. Rule number one: don't lose money. Rule number two: just seed. Rule number one. And that's the same as the family offices. Again, they expect the family to exist forever. And so that what they're trying to do is protect and grow. But the first thing is the protect part. They really are cautious on, what happens in a downturn. What are you doing to make sure that they don't lose principal? To your second part of your question of how do we get connected with them, and this is where being a salesperson helps, a lot of cold calling. And there's also a fair amount of family office conferences that you can get connected with, where you have access and have the opportunity to get in front of some people. I'll give a couple things that your listeners can listen or go and research. Opal, it's OPAL. Opal runs a series of conferences, and there's a family office conference they run on the East Coast, again on the West. There's another guy, his name's Richard Wilson. He runs a group called the Family Office Club. Maybe you've had him on as a podcast, but he's a marketing machine, and he's done a really good job of building a network of family offices. And then there's a few others. If you start Googling around, you'll find them. But I think a big part of it is going out and cold calling with a story, and you only need a few of these to make it worthwhile. So, if you can attract 2 or 3 quality family offices, that's a fairly substantial equity chunk.
Is there ever the worry of saying, oh, wait a minute, we have all our eggs in one basket? If one investor pulls out and he's a $5 million investor, that's a problem, right? As opposed to the $50,000 check. What's your thoughts on that?
Yeah, so we at Reliant, Whitney, we have essentially 3 buckets of equity, right? So we have our, high net worth accredited guys and gals, right? The call it $50,000 to $500,000 investors, somewhere in that range. And we have a pretty sizable chunk, and really my job is to continue to grow that bucket of investor. And then we have a middle bucket of like syndicators, people who have their own retail investors and are looking for access to the asset class with self-storage. And then we have those larger investors. I would call it sort of our institutional bucket. There's a large private REIT that Reliant has a long history with, and then some of the family offices. So I think, Whitney, it's balancing, all of those. My goal really is to make sure that our equity sources are diversified enough where the faucet never turns off. Right? Because typically, in a correction, for example, most of the retail investors go away, right? Everybody locks up. They get very nervous and nobody wants to deploy capital. The institutional side is exactly the opposite, right? They're saying, hey, this is a huge buying opportunity. And I would argue that that's when most of our wealth is created, right? Is, the operators who bought in 2007, 8, and 9, when the world was falling apart, that sold in 2015 and 16, they did okay, and my opinion is that, and what I'm trying to position, or Reliant is trying to position themselves, is that we're in a position in the next correction where we have a lot of dry powder sitting, so that we can go clean up the blood in the streets. And then in that next uptick, we'll be in a position to capitalize on that. So I think you're spot on. You don't want to put all your eggs in one basket, but you do have to continuously diversify as far as where the equity is coming from.
So on that note, going back to those individual investors, what are some creative ways that you've recently, best ways that you found to recently find high net worth individuals and connect with them?
Yeah, for sure. I think, Whitney, you got to identify who you want, right? Call it the avatar of your investor, who a perfect investor is. There's an interesting tool within LinkedIn that one of my buddies turned me on to. He's a pretty savvy online marketer. It's called LinkedIn Sales Navigator. And there's a fee associated with it, but it allows you to really dig into and create some lead lists within LinkedIn. And then you can get people into a funnel of emails or messaging to see if they have interest. And so I would suggest some of your listeners look to that. It's if you just Google LinkedIn Sales Navigator, you'll find it. Allows you just to be really thoughtful. I found LinkedIn to be a pretty powerful tool. We have a pretty sizable follower. Our last post we got 5,000 views on. So we're getting good views there. I think the other thing, Whitney, for your listeners and for me, it's just networking, right? I mean, putting yourself in positions where people are who you think are going to do what you want to do. We've had some interesting partnerships with some physician groups because typically we've had a lot of physicians who've invested alongside of us because they have busy W-2 jobs and they want access to the asset class, but they're not going to necessarily be a direct investor themselves. So I think those are some areas you can definitely focus on. And then, like anything, you just have to first decide what you're going to target and then, create action around how you're going to go get those people. And I think, Whitney, everybody has different skill sets. Mine's a sales background. And so that's really where, my background has helped, is being able to say, okay, these are the people I want to go find. How do I go find them? And what do I do to get in front of them? And it's worked pretty well.
Oh, great advice. I like that. And even mentioning the physicians groups, and was that something that you all have reached out to and found these groups, or is it from, connections or investors that you already had?
Both. I would say both. We've come across, what's interesting with physicians is most of them have a pretty demanding schedule, right? It depends on what specialty, but certainly, doctors aren't sitting around most of the time. And they obviously have disposable income, or some specialties certainly do. But most of them want to share it with a group. I'll give you an example. So one of our attorneys has a client who's an orthopedic doc who asked, "Hey, I'm interested in storage." And our attorney said, "We represent one of the self-storage operators, call Kriss at Reliant." So I talked with him and he said, "Hey, we have a group that we meet once a month within our orthopedic physician group. I know there'd be interest there. Would you do something for us?" And so, of course, from my end of things, there's no downside. And again, it's back to that diversification. Another 20 or 30 docs never hurts. So, opportunities like that present themselves, and, you have to be able to bring them value, and I think that's the big piece for him. He said, "Can you put some slides together for me so I can tell him what you guys do?" I said, "Sure." So, that was something he brought to his group. The group is interested. And so September, we're putting together, a Zoom call like this, or a webinar where, we can see them face to face. They can see us, and we'll talk through who we are and what we're doing. And if they want us to, a group like that is worth flying up to see for a day, a couple $100 on an airplane ticket. There's definitely something about meeting people in person, I think, from a trust perspective, that goes a long way. So that's the other thing I would say, Whitney, for your group is the face-to-face interaction is a huge part of it. And I know, you on the podcast and some other guys who do a lot of podcasting, that's your trust building activity, right? Where people think they know you because they listen to you every day on their car ride to work. And, we don't have that platform. But, having people come in and visit us is a big part of how we make that connection. And to be honest, part of it is we want to make sure we want to work with you too, right? Like I call it the Detroit airport test. Like if your flight got canceled in the middle of winter in Detroit, would you want to go have a beer with that investor? If the answer is no, we're kind of like, that's okay. Fortunately, we're in a position where we can push back. We want long-term relationships, and look, we're asking people 5 to 7 years is a long time to talk to somebody you don't like. So we're sort of just as picky to say, hey, if you're a new group coming to work with us, maybe not so much on the individual investor, but certainly the groups, we want to meet you and have, a dialogue outside just the business to understand if, our values are aligned, because 7 years is a long time, to be married if I don't like you, or if we're not, if we're not aligned on that way.
Definitely. No, I appreciate that. And I like you bringing up also that it's worth flying and meeting them personally. And it's worth a couple $100 to actually be face to face, especially if it's a group. But, it just says a lot, that's worth your time, and you're going to learn a lot more about them being able to be in person. And so, Kriss, what's been the hardest part of this syndication journey or process for you?
That's a good question. I think the biggest challenge for me was, and I think it really resonated this summer for me, was the big deals, small deals are the same amount of work. You just make less money on small deals. And Whitney, what's funny is I know that inherently it's the reason why I went from residential real estate to commercial, but for some reason it didn't make sense to me, or I didn't apply it on the investing side. Chasing individual investors has to be part of it, but depending on what kind of scale you're looking for, it isn't scalable, right? To have 10,000 retail investors is a lot of brain damage. There's a lot of work that goes into that. Or 100 family offices. It's just a huge shift. And I think for me, it was kind of getting out of that, I needed to think bigger, right? Look, there's so much capital that out there that needs to be deployed. And if you have a great opportunity to put that capital somewhere that, that you have high integrity, you have a great track record, you believe you can create a great opportunity for them, boy, there are people out there looking. And the endowment world has sort of opened my eyes to just how much capital exists and the type of partnerships they're looking for. So for me, Whitney, I think it was my syndication grew organically. And then partnering with Reliant really helped solidify the idea that we can take this to a really large scale. And, it helps us grow our portfolio, obviously, and then helps our investors get into an asset class that's really niche-y. It's not as easy. Multifamily, there's a lot of opportunities. Commercial retail. In storage, it's much smaller subset that's doing it. So usually we get a pretty good response. But I would say that's probably been my biggest thing, is kind of that mindset shift from, onesie twosies to, Harvard endowment.
Nice. So how is Reliant ready for another downturn? How I'm sure you probably get that question all the time, but how have you all prepared for another downturn?
Yeah, for sure. I think inherently the asset class has performed well in the downturn. So I'm a data person, so I like to look at a lot of historical data, and I can send you the link to this. You can post in the show notes. If you've never looked at the National Association of REIT data, it's actually REIT.com, REIT. They have a 25-year data set where you can essentially look at any of the publicly traded REITs across any asset class. So if you look at storage in 2007, 8, 9, it lost less than 4% of its value. Just to baseline that, the S&P 500 lost just over 22%. Apartments was just under 7%. So what was interesting is storage, and the hypothesis behind that, right, is people don't get rid of their stuff. It's like workforce housing. You catch people on the way up, they buy stuff, put it in storage. And then when they have to downsize, they take those things, they don't get rid of them, they just put it in storage, because there's always this hope for a better day. So storage did really well as an asset class, which benefits us. But I think for us personally, there's two things we focus on. Is one, the debt, right? So we're trying to be really conservative in our debt allocation. The fund we're doing right now is, in the aggregate, the portfolio has to be less than a 70% loan to value. So typically we're in that 65% to 70% loan to value on the debt side, because that's how you lose your property to the bank, right? Is, you've been too aggressive on your debt, there's a correction, and you're not able to cover the debt service, and you can't go out and refinance the debt. So the debt is one. And then our overall strategy is really around value add, Whitney. where, we're not adding granite countertops and stainless steel appliances to our storage units. Most people probably wouldn't pay any more for that. But what we are doing is trying to find those markets that are strong, that are undersupplied, and we're able to go in and create some expansion or quote unquote institutionalize the product, so that we're essentially looking for an exit to either institutional capital or the REITs. And when you take that value add strategy or that forced appreciation, if you're successful in it, now I start with a loan to value of, let's say, 65%. If I can do my expansion, get it leased up, now that 65% loan to value is in the 50s or low 50s or maybe high 40s. So then that really gives us a big buffer, for the potential of another correction, where unless it's truly catastrophic and we're losing half the value in our property, we're probably going to be in a position where we can always go and secure debt and hopefully get us to that next cycle.
Nice. So, and quickly, how have you all recently improved your business that we could all apply to ours? Maybe, something that you all have done recently.
Specific to the storage assets?
Sure. Either storage or even your the equity arm, either way.
Yeah. I think for us, the storage piece is constant on the underwriting side, right? The market is very dynamic. There's been a lot of development in storage in the last 2 years. That's our biggest risk. So trying to mitigate those risks with how we've done our comp study, for example. I'll give you just a quick example. So with our comp studies, now when we take a property under contract, we get a list of all their tenants. And essentially we have that tenant list geo-mapped so we can see exactly where the tenants live, right? And in storage, typically everybody lives within a 5-mile radius, right? So 70+% of our tenant base comes from a 5-mile radius of the store. And so why we do that is to try to understand exactly how development will hurt us if it comes in, right? Is now you can see the pockets of where people live. And interestingly, geographic barriers create reasons why they don't come, right? It can be a highway overpass. And it doesn't mean that there's not a bridge over it or under it. It's just people don't come from this side of the highway to the other. I don't know why, it just happens. So if a development happens on the other side of the highway, it doesn't affect us as much because we can see where tenants are. So really becoming intimate in that 1, 3, and 5 mile ring around our facility has been an area we spent a lot of time on this last 12 months and will continue to in the future. And I would say for you and your listeners too, Whitney, really digging into underwriting is never a bad thing.
So we're about out of time, unfortunately, but just a couple more quick questions. And what's your best advice for caring for these investors?
For caring for them? Boy,
I think it's coming back.
Yeah. Well, one, you got to deliver, right? I mean, you got to deliver money back to them is a huge component to this. So I think the other thing is, especially investors that you have spread all over the country, you may not see them face to face often, if at all. The big thing is communication, right? Is ensuring that they understand, good or bad, what's happening at the property. So we do quarterly updates that are pretty thorough, and just letting people know, hey, these are the goods, these are the bads. Like, this is what's going on. Maybe we had an unintended expense and that's throwing our budget way off. I mean, at least I can speak for me. I'm okay with bad as long as I knew about it. I don't like to be surprised, a year later when things have been going poorly. If you just tell me up front, look, I understand the business. There are things that are unforeseeable. So my advice would be just a super high level of transparency. And when people ask us like, hey, what are the markets that you're not doing well in? Tell them like, hey, we're getting crushed in this market because, 3 new storage facilities opened up across the street. What do you do? It is what it is. And I think that goes a long way. People understand that, there's going to be good and bad, ups and downs, but that transparency and communication is a huge component of it.
What's one thing that you would say has contributed to your success?
I'm going to give it to my wife. So she's always been a huge component, Whitney, of jumping in. I'm not as brave as I perceive to be. So I've made some really big jumps in my career that people would say, you're crazy. I can't believe you're doing this. And I owe a lot of that to my wife. She's very risk tolerant, and she's always kind of grounded me with the idea of what's the worst that can happen, right? I mean, what do you have to go back and get a job? Like, what if we lose all our money? So, go back and get a job. Like, it's not that bad. And I think when you think through really what the worst things are, it makes it easier to swallow. Now, that being said, I still get sleepless nights. Like, there are those times where I'm like, am I doing the right thing? But I would say my ability to see an opportunity and then jump, even though I may not have all the details yet, has bode very well for me. And that's the thing, if I could leave anybody with one piece, is educate, right? Make sure you know what you're getting into to the best of your knowledge, but you're only going to learn when you're in it, right? You can only learn so much from Bigger Pockets. And then from reading books and listening to podcasts, no offense, Whitney, but at some point you got to get in this business if this is what you want to do, because that's where you're going to learn the most.
Great advice. Appreciate you sharing that too. I completely agree with my wife as well. But Kriss, before we have to go, how do you like to give back?
Yeah, well, right now I'm trying to keep my life afloat. We just moved 2 weeks ago, so our life is in a current state of flux. What we've done in the past is we've done a lot of coaching from an athletic side of things. Fortunately, my kids, I just lost one to graduation, but I've been very fortunate to be able to have coached a lot of their teams on the athletic side, and that's really where I've tried to dedicate the time, is with the kids and on that side. And as they outgrow me, then we'll have to find a new adventure and where to give back.
Awesome. Well, Kriss, thank you so much. It's been a great show. I mean, just you talking about, how you manage and run the equity arm of Reliant and family offices versus individual investors. And it's been great. The pros and cons and how you've managed to connect with those family offices and using LinkedIn and numerous things, and how important the support of your spouse is as well. So, thank you so much for your time, Kriss. Tell the listeners how they can get in touch with you.
Yeah, for sure, Whitney. I'd say three areas. So if you want to learn more about the platform, you can go to reliantinvestments.com. That'll talk to you about Reliant and our track record. We also built a kind of an educational platform. If you go to krisbenson.com, it's Kriss with a K, KrisBenson. We did like a video webinar series, essentially so that when investors have questions about structure, if it's their first time investing in real estate, I can just push them to this series. And then when they come out of that, it's free, and all you gotta do is put your email address in, and they'll come out of that at least dangerous. And then the third thing is on LinkedIn. You can connect with me on LinkedIn. As I said, we're fairly active there, kind of keep apprised of what we're working on at Reliant.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.